Good day, ladies and gentlemen, and thank you for joining us. This is going to be a rather short presentation, about 30 minutes, to go through some of the topics that we think are quite important to note before the exam. As most of you would know, I think at the beginning of the semester we've had classes in different regions. The first classes we've had like in Joburg, in Durban, in Cape Town, Polokwane and East London. So in those sessions we tried to cover as much as we could. I think it was about 4 hours for each session, so that's when we went into detail. So I'd suggest that you go on my UNISA and just make sure that you download the resources that we've posted, the class slides, the examples that you have to go through. Everything is under additional resources I think there's a folder called the discussion class. So the purpose of this of this session is basically not to give you guys a scope or anything about what's going to coming up in the exam. But we do have the stuff that we've posted on my UNISA that we recommend you go through the presentation that tells you the nature of the exam. I'm just not going to go through the first 2 slides. It's just basically to how to prepare for the exam. These slides will be available on my UNISA. Guys, I'm of the opinion that it's going to help you a great deal to make use of UNISA, visit it regularly, because I think most of the stuff we post you're going to find on my UNISA. In fact, I would go as far as saying rather go through those examples first before you look at question bank or past question papers. So that's just preparation for the exam, and also exam techniques in terms of what to do in the exam. So what we are doing here now is just basically going through the overview of the entire module to say what topics should we expect. And I'll say about 90% of the questions would come from 5 topics, or 5 major topics. That would be financial analysis, capital budgeting, capital structure, working capital, mergers and acquisitions, and valuations. And then for others, you've got topics like interest rate risks, dividend policy, forex risk, and so on and so forth. So I think I'm of the opinion that what will make a great deal is for you to make sure that you master all the 5 topics. And now briefly, I'm just going to give you an overview in terms of what you need to expect from each question. So we start with financial analysis, which is chapter 8 of your textbook, and these are ratios. Guys, I'm not going to be asking you ratios as in like a category to say give us profitability ratios. We'll ask you specific ratios that you need to calculate for us. And then what you might also be required to do is more like the risk assessment and understanding the nature of the business. So that's what you normally find under ratios. And then we come to mergers and acquisitions and business valuations, which is chapter 11 and 12 of your textbook. Now, this is where one business is buying another, or they're buying a stake in that business, or it's 2 companies that come together. Now, there's 4 valuation models that you need to know there. That's net asset value, that's market capitalization, there's price earnings multiple, and also discount cash flows or free cash flows. So those are the topics or the models that you must make sure that you are comfortable with, and also to be able to advise on the purchase price. Then just one thing I want to highlight at this stage: if you've got any questions or something that you're not clear of as I go along, just type your questions, and then we've got someone to attend to them. And then when you come to capital budgeting, now this is when you're buying a new machine, or it could be like where we're increasing capacity within our production processes, or we're opening a new store. It could be any project. So we're saying we're investing in that project. What is it that is required of you, or what is it that we expect you to know? And now in this case, we'll have, you must be able to calculate your NPV, you must be able to calculate your NPVI, your internal rate of return, payback period, and then you also need to be able to come up with qualitative factors. When I say qualitative, it means that those factors that cannot be quantified, that you cannot attach an amount to them. So we've used in our previous examples that pastel logic to say identify political environment, and so on and so forth. And then after that, you come to the financing, to the capital structure and sources of finance. That would be chapter 4, 7, and 10 of your textbook. And now basically this is about how do you fund your business? How much debt do you use? How much equity do you use? And then how do you establish the cost of capital? Now, in this case, you would have, you might be required to calculate work, you might be required to calculate net present cost, or you might be required to say, how do you move from the current capital structure to the target capital structure? Yeah, so those are the things that you should expect under the capital structure and sources of finance. Another thing that we want to look at is working capital, and now this is where you compare the existing policy versus the new policy, and on debtors, creditors, inventory, and cash. Another way to look at this is to say maybe where you have to compute the key ratios in working capital. That would be your liquidity ratios. So basically, in a nutshell, this is how you want to approach this exam, or this module rather, to make sure you are okay, or you are able to answer questions to each and every particular topic. I think for this session, however, I'm going to try to cover as much as I can, but I just look at financial analysis briefly, then capital budgeting, and then if we've got enough time, we'll look at capital structure. If we've got another opportunity in the near future, hopefully, then we'll be able to look at mergers and acquisitions and working capital. These ones are of equal importance. Now, just starting with the financial analysis, what we want to say here is just maybe a few things to note is that you make sure that your answers, you express them correctly. If it's a times, make sure that you put a times. If it's a percentage, don't just write 0.2. It must be 20%. And if it's a ratio, x is to 1, just make sure that the presentation is okay. Then you can ignore these ratios. We have to be careful now. I'm saying return on invested capital, not the entire cluster of ratios, just that ratio in particular. So you'll still be required to do ROA, ROCE, ROE. Then we've got EVA there, then cash flow related ratios. I think these ones we can actually leave out. Then it comes to the mark allocation. It's not really standard, but then what we see more often is that you get 2 marks for the calculation and 1 mark for the comment. Now, when it comes to the calculation, we're saying basically the 2 marks is probably going to be coming from the numerator, a mark, and the denominator, it gets another mark. And then for the comment, we're saying refrain from stating the obvious. I'll show you now in a second what I meant by that. And also just stating that there's the direction of the movement, that's not going to get you a mark. So let's just look briefly at how or what you should be expecting when it comes to the comments. Now, you have to be careful that there's 3 ways basically that you should expect to structure your comments. The first one would be to say, let's look at the reasons why there's a movement. And this one is quite common. The second one would be, what are the consequences of having an adverse ratio? So what are the consequences of having such a low ratio? And then the third one would be to say, what are the ways that we can implement to improve this ratio? So it is important that from the onset you know exactly what is required in the question. Just a few tips to give there. Then please avoid explaining what the ratio does. A simple example here is when you calculate the ROA, return on asset. Now, the return on asset, what it does, it measures the effectiveness of the assets in generating profit. So you cannot say, now the reason why the ratio has improved is because it means that we're more effective in using the assets. Though that's not the way to go about it, but then what you want to do is say, explain why there is a movement, why has it increased, why are we more effective in the use of the assets. And please try to keep the sentences short, but then at the same time make sure that it's clear and the sentences are well structured, precise and straight to the point. Check your answers for reasonability, and then note the mark allocation as well, which I touched on earlier on. Then and then also take cue from the ratio name. I mean, I say this all the time. For example, if you've got a PE ratio, then that ratio, you should know it at the back of your mind, because it says price slash earnings. So it's share price divided by earnings per share. If it's gross profit margin, anything that has got margin, then you know that you divide by sales. So you must always look at what the description is, and then please avoid or rather stick to the ratios that are required. I think most of you will probably want to go back to what was asked in the previous semester and then answer those ratios and not look at what is being required at that time. And also try to maintain a balance, try to use the information that is given in the scenario. In fact, I think this is where you want to start. And then the other thing that you want to do is also use more like logic, things that are not given in the scenario, but that you know very well they apply to the scenario. So just a quick question that I want us to go through here is the calculation of a gross profit margin. So in this case, you're given two data sets, 2017 and 2018. Sales 100, and then the following year you've got 200. So they've basically doubled. Then we look at cost of sales is 60, and then the following year is 130. It's actually more than doubled. Gross profit is up from 40 to 70. So you can see from the word go here that as much as we've made more profits, but then our sales have actually increased more than our cost of sales, and our cost of sales has increased more than our sales. Now, let's look at the calculation first, and then the calculation will be gross profit divided by sales, and then 2017 we've got 40%, and the following year it's got 35%. Now the problem starts with the interpretation to say, now how do we explain the difference between the movement? How do we explain the movement from 40% to 35%? So you just want to state that there's an increase, or there's a decrease rather, of 5%. Now this is due to, now let's look at the reasons. Now we're saying there is no mark, you're not going to get any mark for stating the obvious. And then the obvious in this case would be to say there's a decline of 5% in profit that we can see. Another way is to say cost of sales has increased higher than the sales. I think that's what I alluded to earlier on, to say 60 to 130, that's actually more than doubled, whereas our sales have only increased from 100 to 200. So these are just these are the things that you should be avoiding. These comments will actually not earn you any marks. So what you want to do actually is, firstly, is to look at what makes up the ratio. Look at the variables that you are using. Look at the numerator, look at the denominator. Your comments should be in line with those. So let's take gross profit margin. We're going to say sales less cost of sales divided by sales. So cost of sales and sales, that's what I want to comment on. Now I might say, now let's look at this. Suppliers might have increased their prices during the year. Now you understand that would have led to the increase in cost of sales. Or another way to put it would be to say maybe the rand has weakened against major currencies, and that would have meant an increase in our cost of sales. Another example here is that the company might have actually stopped buying in bulk where they used to qualify for discounts, or maybe they no longer qualify for a discount now, and therefore as a result your cost of sales has increased. Now you look at things like the company might have reduced the selling price as well, and then the last one, we're selling to overseas customers. So it's a number of points that you can come up with, and again you're just looking at sales and cost of sales, anything that might have actually affected those two accounts. That's what we are interested in. Again, probably for a mark in the exam you just have to come up with one. Advice would be to get one or two of these actually. And now some of the practice questions that I would recommend for this topic would be African Fish and Chips, CTMA, and Edgar's. And I think the first three are actually good for both the calculations and the comments. Then the last two, I think, let's rather focus on the calculations. And the reason why I'm actually highlighting these questions is because you cover all the ratios. You don't want to be focusing on questions that just deal with 5 or 10 ratios, because you never know which ones are going to come up. Then the next one is capital budgeting. Like if you remember, we said earlier on, this is where we are buying an asset, we are replacing an old machine, we are expanding our operations, we are increasing capacity, and so on and so forth. Now here, what you need to take note of is just you must be at least able to calculate the following. Basically, use the following techniques to calculate the profitability of the project. So the first one is the net present value. You can use a financial calculator for that one, as long as you show us the steps. Net present value index, and that one is actually a derivation from the net present value. Then the third one is your internal rate of return. Again, here you can use a financial calculator as long as you show us the steps. You can do the interpolation, but it's actually not necessary if you've got a financial calculator. The other one is the payback period, which will cover the normal and the discounted payback period methods. So these are the methods that you just have to make sure that you understand and you are familiar with. Now, the way I would approach a capital budgeting question is basically to have a checklist to say every time I'm approaching this question, I must know exactly what is required. What is going to be important here is that you put everything in the year in which those expenses or those cash flows take place. So, for example, you know that we are investing in an asset, and therefore we might require to put up an investment or to make an investment initially. So that's something that I'm expecting from my capital budgeting. Another thing that I want to look at is the working capital as well. To say, now if the question just says working capital, then you assume that it has to be reversed at the end of the period, unless the question states otherwise. And then you've got sales, cost of sales and expenses. So now the reason that you are undertaking this project is that you generate income or sales out of it. But then you must bear in mind that you might have costs and other operating expenses. And now here, this is when it becomes more important for you to understand the structure of your income statement, what goes in there. And then you've got relevant costs. I mean, some of these ones, like for example, some costs might not be relevant. You might have non-cash items that also go in. So in that case, just make sure that you indicate. If it's irrelevant, just note that this one I'm not bringing it in because it's irrelevant. Now you've got what is like at the end of the project, chances are you're going to sell the asset, so you must bring in that. Another thing to take note of is the continuing value. There are instances where we say this project is going to run in perpetuity. So in that instance, you must establish the continuing value, which is something that we've done in discounted cash flows as well. You can go to page 451 of your textbook, I think, just to see the concept of continuing value. Another thing that you want to look at is the taxation table. For tax, guys, I think you must make sure that I prefer personally to do the tax calculation separately. It just makes my workings neater. And then just make sure that there you highlight things like your wear and tear, you bring in your wear and tear, your recoupment, or your scrapping allowance. Then the last point is the discount factors. It just shows the steps. You don't even have to calculate the factors for each year, as long as you show the steps that you are using. This is one question, this is one example that we've got. So maybe you can, just to practice, use this question and then check it against the checklist and make sure that you are able to cover all the items that are required. We've also attached the solution. But one thing I want to highlight here is where it says net cash flows. Guys, now the question might ask you a technique that you don't even know how it works. Let's say maybe payback period or NPVI or anything like that. But what is important is that the majority of the work that you have to do has to do with putting the amounts in the right years. So that's where a lot of workings, where you have to do a lot of workings. So it doesn't matter exactly which method is asked, as long as you are able to identify the net cash flows for each year. This is what is important here, because from there on now, then you answer according to what is required in the question. And again, here we've explained some of the lines to say where the numbers are coming from, the logic behind what to be on the lookout for, and so on and so forth. And this is the text table which we've shown separately as well. And now we come to financial management. Now it's basically to say what is financial management all about, and then I'm saying it's basically your investment decision and your financing decision. Now the way I look at this is these are long-term decisions that we want to invest in a project, and we're going to have this project for a number of years, say 5 years. Or it's a financing decision. We need to raise a loan, and it's a long-term loan. We have to repay it over the next 5 years. So when it comes to investment decision, you are looking at the valuations. For example, when you value a company, you look at the number of years that you're going to be making profits out of it, and then the net present value as well, to see how much, what is the value of the project that you are you are evaluating. And then on the other side, where we look at the financing decision, you are concerned about the cost. How much is this thing going to cost us? And this is why we do the net present cost, and this is why we look at things like your weighted average cost of capital. So now just a quick examples I want to show here, and it's that concept of time value of money to say, let's say you are investing in a machine which is worth 1,000 now, and it's going to generate the following cash flows for the next 5 years. Then you've got 240, 385, and so on and so forth. And then on the other hand, you might have a situation where we say there's an existing debenture of 1,000, maybe a loan we took a couple of years ago, which is going to be redeemed in 5 years. And now you have to establish the value, or how much, what's the market value of that loan is today. If the interest is 10% and there's a premium of 5%. So in that case, this is the nature of your cash flows from year 1 to year 5. So basically, one here at the top, we're looking at the investment decision, which could be measured via your NPV, IRR, and so on and so forth. And then this next one is where we're looking at WACC, the cost, or rather the net present cost of the item. But then the approach is the same. At the end of the day, we are still interested in how much is going out or how much is coming in. So now the way you want to do this, once you've established your cash flows, let's say now the first one we're going to discount at WACC, then the second one we're going to discount at the cost of debt. So if we look at the first one, this is what I was talking about earlier on, just to show the workings, to show exactly the steps that you have taken. So in this case, you can just say CF0 for year 0 and so on and so forth. And then the interest would be 15%, that's your I, that's your WACC, and then you compute the net present value. So as long as you show the calculations and the steps that you have taken, or you can use the alternative, which is shown at the bottom of the page, where you just show the steps 0, CF0, and so on, and so forth. Okay, I think we just have under 10 minutes, if I'm not mistaken. Again, guys, I think we've got these notes on my UNISA, so just go through them. If there's anything you do not understand, you are more than welcome to contact us. And now we look at the capital structure. This is study unit 2 and 3. Now, its capital structure, it basically talks to how the business is financed, how much is debt and how much is equity, because that's how the business is financed. So we are saying that's basically the same as your capital employed. Now, when I'm talking about debt, I'm talking about long-term liabilities. So we would actually exclude things like your bank overdraft. We exclude things like a short-term borrowing, a borrowing that you make for like 6 months. But then what you want to focus on is long-term liabilities that are interest-bearing. Now, a short-term portion of a long-term loan would also be part of your debt, your long-term liabilities. Now, guys, it's actually important for us to know what falls under equity, what falls under liabilities, for us to be able to establish exactly how much is debt and how much is equity. So under equity, what I've got is ordinary share capital, retained income, non-distributable reserves, and preference shares that are irredeemable. So this is money that is not going to come out of the business, like the funders are not going to demand it back per se. Then on the other side is a liability where at some point we have to repay it. Now that would be a long-term loan, a debenture, a bond, or a redeemable preference shares. I've got notes there at the bottom, so you can just go through there to familiarize yourself more about this, because really this is important for you to know exactly what is what, because it has a serious impact when it comes to the calculation of the cost of capital. Now, most of the time you would be required to advise on which financing option to go for. Now, the major question now becomes, what are the factors that you need to consider in that instance? Now, we are saying, so now if I have to decide how to fund my business, whether to use a loan, a debenture, or a preference share, what I want to look at is the cash flows. Do I have to pay this every month or every year, or just a bullet payment right at the end? I want to look at the capital structure as well. If the company has got a target capital structure, then therefore I must make sure that I work towards that target capital structure. They've just told me that I've got 5 minutes left, so I'm really trying to keep up to speed. And then you look at the capacity to say, do we actually have availability of the resources? Like, do we have authorized share capital, shares that we can issue? Do we have are banks willing to give us the funds? and then we come to the cost. Obviously, we're going to go for something that is cheaper. We look at the tax impact because that might actually reduce our cost further. We look at the control. If I issue shares, I might dilute the control. And then I look at the constraints, which is which maybe the bank, if I borrow from the bank, they might impose restrictions to say I'm not able to move. I cannot sell this asset. I cannot do A, B, and C on this asset. I must achieve this much every year. So, and the way I've done this for you is to basically say C, everything starts with a C. But now what requires more, most of the time what requires a lot of calculations is the capital structure, how to move from the existing capital structure to the target capital structure. And now we've got a number of examples that you can go, that you can look at. Ties and Styles of Africa, for example, Simonye Gold, I think the CNA and Simon and Son. So these actually cover the concept of how do we move from the existing capital structure to the target capital structure. The next concept is WACC, which we are quite familiar with, and the net present cost, again, is just to establish how much the asset, the loan is today. So now let's look at WACC, and then we're saying this is a cost of capital, just 2 or 3 minutes on this topic. Now we're looking at the cost of capital. How much does it cost us percentage-wise to borrow from the bank, from shareholders, and so on and so forth. So now what you might want to do first is just to calculate the cost of each instrument. Cost of debt, and I've given you all the formulas that you need. Cost of debt, cost of pref, cost of ordinary shares. So once that is identified, let's say now we're trying to establish or to calculate what our WACC is. Now we are saying target capital structure. So we're saying the way we're going to calculate WACC, firstly, we look at the target capital structure. If a question has got a target capital structure, therefore we must use the target capital structure to calculate our WACC. So we might say 40/60, and that's what we're going to use to calculate our WACC. Then the second one is, if we do not have a target capital structure, the question is silent on target capital structure, or we're specifically told to use the market values, then in that case we will use market values. And this is where we might have to calculate the market values first, and then after that, if the two options are not applicable, then we use the book values, which is numbers we take straight from the balance sheet. Now, the first one is when we are using the target capital structure, definitely means that we do not need to calculate the market values. We just look at the weight to say, if you say it's 40/60, that's what we use to calculate WACC based on the target capital structure. The next one, so in this example, we've got where we've got the values now, we're bringing in the market values. So most of the time we have to calculate those market values, which brings me to the next question of saying, how do we actually calculate that market value? And now the way we calculate market value, I just say these are the steps that you have to follow for every instrument. To say, let's start by looking at the number of units and the market price, the going price. And in this case, like look at the ordinary shares, you say the market capitalization, the number of shares issued multiplied by the share price. Now you can use that for preference shares and for debentures. So now if let's say you don't have that information, you would go to the next one to say now we have to use the financial calculator. What is important with the use of the financial calculator, or we can use the PV factors if you do not have a financial calculator. With this one, what you have to make sure is, what you have to look for is, do you know exactly when the instrument is going to expire or when the debenture is going to mature? So if you've got that information, then you can use the financial calculator, because if you don't have N, then it's going to be impossible for you to use the financial calculator. Then the last one is the use of is the market yield. Market yield is pretty much the same as what you have for a dividend growth model, which is D over P. That's the formula in its simplest form. So for KE, you say D1 divided by P0 plus G. Now, if you want to establish the market value there, you just make P0 the subject of the formula. Now, you can use this formula also when you have to calculate preference shares, especially when you do not know when the shares are gonna be redeemed. In that case, this is where you're gonna have KP equals D over P, you can say MVP. So we are basically rewriting that formula. And again, guys, I think you've got more details on the slides that you have provided. Second last, again, I just want to highlight this to say the market value. Now, when do we use the formula or the financial calculator? We're saying if we know when the instrument is going to expire, and then in all the other instances we probably use the market yield when the date is unknown as to when they will expire. And lastly, or when the question specifically tells you to use the market yield. Guys, that's actually my last slide, and thank you for bearing with me. I'm sorry that I had to rush through this, but then in a nutshell, what I want to say is that you've got a lot of resources that are posted on my UNISA, and I will encourage you to make sure that you go through those. And then we're gonna have our final session. It's actually our 4th session for the FASET. So, so for anyone who's able to attend in Pretoria and in Cape Town, it's going to be on the 19th, a few days before the exams, and then Durban is going to be on the 20th. And the purpose for this is basically to go through the exam techniques and just to make sure that you are prepared for the exam. It's not going to be us trying to explain any concept, because at this stage we're hoping that at least you are almost there in terms of preparation. Thank you very much again for your time. Bye.